Hedgers! Welcome back to an exciting discussion about PSAK 71 Part 2, where we will be diving deep and talking about a really cool topic, hedging. Now stay tuned as we are going to explore more on the concept of PSAK 71 comprehensively later. Now, before we start, let's get to know our presenters for today. First we have Insan, and my friend Matthew, Maura, that's me, Stefanny as the team leader, Vincent, and also Vitha. Now, what we're going to be discussing today are these 5 main points: the basic concepts, scope, and objectives of hedge accounting, hedging items, qualifying criteria for hedging, types of hedging, and last but not least, hedging of item groups. Now, for the first part will be explained by my friend Matthew.
So the big concept here is hedge accounting. But what actually is hedge accounting? From accounting point of view, hedge accounting means designating one or more hedging instruments so that their change in fair value offsets the change in fair value or the change in cash flow of a hedge items. We're talking about hedging instruments and hedge items. Before we continue, we need to agree on something first. Believe it or not, all entities are exposed to some form of market risk. For example, gold mines are exposed to the price of gold, airlines to the price of jet fuel, borrowers to the interest rate, and importers and exporters to the exchange rate risk. Now we continue about what hedging actually is by giving you an illustration. Imagine your company that normally operates in US dollars. Recently, your company has decided to spread its business to the European customer for, let's say, 20 million euros. Invoice to the European customer is due after 9 months. However, story doesn't end well. Your company is afraid that due to movement in foreign currency rate, it will get significantly less US dollar after 9 months. And therefore, it enters to the offsetting foreign currency forward contract with bank to sell 20 million euro for some fixed rate after 9 months. US producer face foreign currency risk that might alter the amount of US dollar received after 9 months. Following the illustration here, what is called the hedge item is the receivable to European customer due in 9 months. As we can see, the US producer and the European customer. This is hedge items, and the hedging instrument is the transaction between US producer with the bank. As we can see, it is an offsetting instrument of the receivable, so when US producer incurs foreign currency loss on the receivable, it increases foreign currency gain on the forward contract and vice versa. Now, what happens after 9 months? First of all, US producer gets paid 20 million euro from the EU customer, but at the same time, US producer, as there is a forward contract with the bank, US producer pays this 20 million euro to the bank and receives some predetermined amount in the US dollar. Effectively, he fixed his exchange rate 9 months ago when he entered into foreign currency forward now. As we can see in our accounting records, when you don't apply hedge accounting, we're assuming that the price goes down, then you will recognize full loss in your profit and loss statement. But with hedge accounting, you will apply accounting treatment for cash flow hedge in this case. In other words, you will recognize an effective portion of your hedge to other comprehensive income, and the remaining loss is recognized to the profit or loss finance expenses. So as you can see, with hedge accounting, the impact of fair value changes of derivatives or any other hedging instrument on your profit or loss is significantly lower. In other words, profit or loss shows much smaller volatility with hedge accounting than without it. Previously, accounting for derivative financial instruments under international accounting standards is covered by IAS 39 or PSAK 55, which discuss about financial instrument recognition and measurement. However, hedge accounting rules in IAS 39 are too complex and strict. Many companies that actively pursue hedging strategies could not apply hedge accounting in line with IAS 39 or PSAK 55 because the rules did not allow it. But on 19 November 2013, IFRS 9 or PSAK 71 was amended. So now we have 2 standards of hedge accounting, which is IAS 39 or PSAK 55 and IFRS 9 or PSAK 71. We're talking about basic concept of hedging and the standards, but actually, why do we need to use hedging? The aim of hedge accounting is to provide an offset to the mark-to-market movement of the derivative in the profit and loss account. For a fair value hedge, this is achieved either by marking to market an asset or liability which offset the profit and loss movement of the derivative. For a cash flow hedge, we use the one that called cash flow hedge reserve, which means we're moving some of the derivative volatility into a separate component of the entity's equity. That's all from me. Next will be explained by my colleague Insan.
Thanks, Matthew. Now I want to explain about hedging items. In hedging items consists of three different types of hedge accounting. First, fair value hedge. Second, cash flow hedge. And third, hedge of a net investment in a foreign operation. According to PSAK 71, the first one is fair value hedge. Fair value hedge is a derivative that is used to stem or offset the exposure to changes in the fair value of recognized assets or liabilities or unrecognized company commitments. In a perfect hedging position, the profit or loss on the fair value of derivative and asset or liabilities hedge must be equal and offset each other. The second one is cash flow hedge. In the cash flow hedge is a hedge against the exposure to variability in cash flow that can be attributed to certain risks associated with recognized assets or liabilities. For example, out of part of future interest payments on debt with variable interest rate or which can be attributed to certain risks related to the forecast of transactions that are likely to occur and can affect to the income statement. In general, derivatives are measured and reported at their fair value on the balance sheet. Gains or loss are reported directly to net income. However, derivatives used in cash flow hedge are calculated at the fair value in the balance sheet, even though gain or loss are recorded in equity as part of other comprehensive income. The last one is hedge of a net investment in a foreign operation. A company may wish to hedge against the risk of change in exchange rate. It is net investment of foreign operation. Net investment is the amount of the reporting entity's interest in that operation. Foreign operation can be subsidiaries, associate, joint venture, or branch. An entity can hedge foreign exchange risk, such as one, protect the value of fair value from an unrecognized commitment or from securities available for sale. Second, hedging the cash flow from transactions in foreign currency that are expected to occur. And the third, hedging of the value of net investment is business activities abroad. Okay, this is a big picture about in categories of hedge. The first one is fair value hedge. The second one is cash flow hedge, and the last one is hedge of a net investment in a foreign operation. Next, determination of hedging instrument. In general, there is a measure of fair value for the hedging instrument as a whole, and the factor that cause change in its fair value to be highly related. The entity can set an overall hedging item or component of an item as hedging item. The entire hedging item includes all change in cash flow or fair value of an item. Component items consist of changes in the fair value or variability of cash flow of an item whose amount is lower than if overall. Okay, thanks.
Alright, now I'm going to be explaining about the qualifying criteria for hedging based on PSAK 71 paragraph 6.4. Now, there are certain criteria that have to be met to fulfill hedge accounting requirements. The first one is eligible hedging instruments and eligible hedge items. So according to PSAK 71, both hedging instruments and hedge items must meet the requirements that has been explained before to be classified as eligible. And also, according to IFRS 9, which the PSAK 71 is adopted from, the hedging relationship should consist only of eligible hedging instruments and hedge items. And certainly, there are changes on what is eligible for both hedge items and instruments from the previously IAS 39. Now, the second one is formal designation and documentation of first, risk management objective and strategy, hedging instrument, hedge item, nature of risk being hedged, and hedge effectiveness. Now, the formal designation and documentation must be in place at the inception of the hedge relationship. Now, as a result, the documentation will no longer be static, but must be updated from time to time. Examples of situations where modification of the hedge documentation will be required are where the hedge ratio is rebalanced or where the analysis of sources of hedge ineffectiveness is updated. In addition, entities will need to update their hedge documentation for all their existing hedging relationships. Some of the expected changes are the incorporation of the hedge ratio and the expected source of ineffectiveness and the removal of the retrospective effectiveness test. Now moving on to the third criteria is hedge effectiveness requirements in a prospective way. Now, hedge effectiveness is defined as the extent to which changes in the fair value or cash flows of the hedging instruments offset changes in the fair value or cash flow of the hedged items. Now, similar to the IFRS 9, which introduces 3 hedge effectiveness requirements, PSAK 71 also has 3 hedge effectiveness requirements, which is economic relationship existing, credit risk does not dominate value changes, and designated hedge ratio is consistent with risk management strategy. Now, both IFRS 9 and PSAK 71 requires the existence of an economic relationship between the hedge item and the hedging instruments. So there must be an expectation that the value of the hedging instrument and the value of the hedge item would move in the opposite direction as a result of the common underlying in hedge risk. Now, the second one is credit risk does not dominate value changes. Even if there is an economic relationship, a change in the credit risk of the hedging instrument or the hedge item must not be of such magnitude that it dominates the value changes that result from the economic relationship. Because the hedge accounting model is based on a general notion of there being an offset between the changes of the hedging instrument and those of the hedge item. The effect of the credit risk must not dominate the value changes associated with the hedge risk. Otherwise, the level of offset might become erratic. Now, moving on to the third one is the designated hedge ratio is consistent with risk management strategy. Now, the hedge ratio is defined as a relationship between the quantity of the hedging instrument and the quantity of the hedge item in terms of the relative weighting. IFRS 9 previously has introduced that it requires that the hedge ratio used for hedge accounting systems should be the same that is used for risk management purposes. Now, we'll be moving on to types of hedging, which is based on PSAK 71, paragraph 6.5. The entity applies hedge accounting for hedging relationships that meet the qualification criteria, and there are 3 types of hedging accounting which will be explained later on. Now, first we will be talking about the termination of prospective hedge accounting. That first, it can be terminated because it doesn't meet the qualifying criteria as I've explained before, and also if it has expired, sold, or has been terminated or executed by the owner. And next will be explained by my colleague, Vitha.
Okay, first of all, thank you, Maura, for giving me chance. Today I'm going to explain to you about fair value hedge and cash flow hedge. Well, basically types of hedging consist of three, which is fair value hedge, cash flow hedge, and net investment hedge. But in this chance, I'm responsible to give explanation to you about the accounting treatment for fair value hedge and cash flow hedge. Okay, let's start with fair value hedge. So fair value hedge is the hedge of an exposure to changes in the fair value of an asset or liability. Fair value hedge is used when the company is looking to eliminate or adjust the exposure that arise from changes in particular risks, such as interest rate raised on a fixed rate debt instrument. Next, jump into the accounting treatment for fair value hedge. Based on PSAK 71, paragraph 6.5.8, the gain or loss on the hedging instrument is recognized in the profit or loss. I'll give you an example to give you a clear understanding about this. Okay, here I'm using a firm commitment. Give you time to read the question. So in the question, we're given two periods, which is January and March, but I pick February 28 to make it three periods so we can see very clear what I've explained before. I've listed spot prices, future prices for you, and in the third row we have entries with broker for future contracts, and in the fourth row we have entries for firm commitment with supplier. Okay. In January, there's no entry recorded because all we need to do is documentation. When you enter a contract in the January, you record no entry because you just need to do documentation. But in the February 28, when the price went down from 42 to 41, you recognize. When you made an entry with the broker, you recognize gain of $1, because when you made a future contract, it means you have right to sell the cotton at 42, while people in the market sell it at the price of 41. And as I mentioned before, based on PSAK 71, any changes of value of future contract or firm commitment goes to income statement or profit or loss. And in interest firm commitment, when the price goes down, you recognize loss, because when you have a firm commitment, it means you should buy the cotton at the price of 42, the price that we locked in, while people in the market buy the cotton at the price of 41. So you recognize loss, and you can see the future contract and firm commitment is offsetting one another. So we have gain or loss equal null, and we recognize asset and liabilities of 1 million. And at March 31, when the price went down from 41 to 37, when you made entries with broker, you recognize gain of $4, and when you made T account, the total amount of futures contract is 5 million. Because 1 million in the debit and 4 million in the debit, so the total is 5 million. And then when you make future contracts, it means you want to make money out of it, so you debit cash and you credit future contract. Future contracts. And in interest for firm commitment, when the price goes down, you recognize loss of $4, and in this state you pay suppliers, so you credit cash of 42 million, and then you debit inventory 37 million, because the spot price is 37, and you debit firm commitment of 5 million, which is the difference between $42 and $37. And essentially, I have converted a fixed price of 42 per ton of cotton to $37, which is the floating price. My cash is still the same. Net cash is $37 million, and inventory is $37 million. Also, the point I want to show you is fair value hedge is converting a fixed price to floating price. Why would somebody convert fixed price to floating price? So what if my selling price can float? If I can increase and decrease the selling price, and I have volatility to the cost of goods sold, why not have them both floating so we can lock those margin? Okay. Next, we jump into cash flow hedge. So, cash flow hedge is the hedge of changes in the cash flow associated with an asset, liability, or forecasted transaction. Cash flow hedge is used when an entity is looking to eliminate or reduce the exposure that arises from changes in the cash flow of a financial asset or liability or other eligible exposure due to changes in particular risk. Next, jump into the accounting treatment for cash flow hedge based on PSAK 71, paragraph 6.5.11. If the hedge is effective, changes in the fair value portion of gain or loss is recognized in OCI or other comprehensive income, while the ineffective portion, if any, is recognized in profit and loss. Okay, I'll give you a simple example to get a clear understanding. Here I use forecasted transaction as this example. I'll give you time to read the question. Okay, in the question, we're given two periods, which is January and March, but a peak of February 28 to make it 3 periods so we can see very clear what I've explained before. In this case, the entity planned to buy cotton. I've listed the spot price. I've listed the spot price and also future prices for you. And in the third row, we have entries with broker, and in the fourth row, we have entries for firm commitment. And in January, there is no entry recorded in making entries with broker or entries with for forecasted transaction because all we need to do is documentation. And in February 28, the price went up from 42 to 45. When you made entries with broker, you recognize gain of $3 because when you made a future contract, it means you have the right to buy the cotton at 42 while people in the market sell it at the price of 45. And as I mentioned before, based on PSAK 71, any gain or loss recognized goes to OCI. In entries for forecasted transaction, there is no entry recorded until delivery of cotton at March 31. At March 31, price went down from 45 to 44, and when you made entries with broker, you recognize loss of $1 because you actually can buy cotton at 44, but since you have contract with broker, you should buy at 45. And when you made T account, the total amount of futures contract is 2 million. When you made future contract, it means you want to make money out of it, so you debit cash and credit future contracts. And in entries for forecasted transaction, you debit inventory 44 million because the spot price of cotton is $44, and you credit cash because you're gonna pay $44. We can see the net value of cash is $42 because the cash in the debit and cash in the credit is offsetting one another. The cash that I receive in the future contract and the cash that I'm paying out in the market is the net of amount 42 times 1 million, and I converted an unknown price to fixed price. If I have future contract of 42, the net amount I'm gonna pay will always be 42 times 1 million. And the next will be explained by my friend Stefanny.
Okay, thank you Vitha for your explanation. Now, continuing to Vitha's explanation, now I will explain the last type of hedge, which is net investment hedge. A net investment hedge is used to eliminate or reduce the foreign currency exposure that arises from an entity's net investment in foreign operations, as well as the monetary item that is recognized as a net investment. Well, we all know that a company which has a net investment in foreign operations
should do consolidation at each period to the parent financial statement. Thus, a foreign currency gain or loss is recognized in OCI. As this scenario can cause a higher volatility in company's equity section, the company can use a net investment hedge to eliminate or reduce it. The hedging instrument itself can either be a derivative instrument, such as a foreign exchange forward contract, or a non-derivative instrument, such as a foreign currency denominated debt instrument, or a combination of both. Well, the accounting treatment between the net investment hedge and the cash flow hedge is very similar. The net investment hedge reserve should be adjusted to reflect the lower of the change in fair value of the hedge item, and the change in value of the hedge instrument since its inception. Furthermore, when we use the derivatives for hedging, we will recognize the effective portion in OCI, while for the ineffective portion is recognized in the profit and loss. Similarly, if we use the non-derivative ones, the foreign currency translation gain or loss is recognized in OCI. In this case, the effective portion is the portion that is written off each other, while the ineffective portion is the remaining gain or loss that is required for balancing the reserve. In the case of disposal or partial disposal, the OCI amount related with the effective portion is reclassified to the profit or loss. Okay, there is an example regarding the fixed cross-currency interest rate swap in the net investment hedge. Okay, so company A with a pound sterling GBP as its functional currency has a net investment in a foreign subsidiary which amounted of 120 million. Company A wishes to eliminate the foreign exchange risk using the CCIRS, while the swap has the GBP 100 million, and assuming that the GBP 100 million and US 80 million are equivalent based on the spot rate at inception, while the swap has annual interest settlements, a 5-year maturity, and a 0 fair value at inception. So now, for the solution with the first approach, the net investment hedge will be treated as the cash flow which is arising from on a deemed sale of US 4 million of the net investment at the end of its next 4 years. And the total net investment of US $120 million exceeds the aggregate of the deemed disposals, which is amounted to the 100 million. Thus, this designation is acceptable. This net investment is identical to the profile of cash flows of a US $80 million foreign currency debt, which is the company A asset that pays annually at 5%. Hence, the effective portion of the gain or loss on the swap can be measured in a manner similar to the use of for the cash flow hedge of a fixed rate foreign currency debt. Okay, now for the approach 2, the net investment hedge will be treated as a long-dated forward. The key differences is that the forward points due to the interest differential on the two currencies are paid off over the period rather than at the end. Okay, the exchange of the principal can be seen as the spot component designated as the hedging instrument, with the interest cash flows being seen as forward points and excluded from the designated hedge. While, as with the approach 1, a hypothetical derivative method is used to measure the effective portion of the gain or loss on the swap. Okay, now, regarding the time value of options, when an entity separates the intrinsic value and the time value of an option contract and designates only the change in intrinsic value of the option as the hedging instrument, then it should recognize some or all of the change in time value in OCI, which is later will be reclassified from the OCI to the profit or loss as a single amount or on an amortized basis. Well, the reclassification is as follows. For the changes in fair value of time value of options, which is related with the transactions, it will be recognized in OCI. So for the first scenario, if the hedged item causes the recognition of a non-financial asset or liabilities or firm commitments, then they have to recognize an initial cost or other cost of the asset or liabilities. So basically, it's a capitalization. Well, for the other hedging relationship, they have to reclassify the profit or loss when it affects the PL. And if it can be restored, then a direct reclassification to profit or loss should be made. Well, for the changes in fair value of time value of options, which is related with the period of time, it will be recognized in OCI, and the reclassification to profit or loss is doing on an amortized basis. So that's all from me. So the next part will be explained by Maura. Thank you.
Thank you, Stephanie. Now I will be explaining about the accounting for forward element for forward contracts and currency basis spreads of financial instruments. Now, according to IFRS 9, a forward is a contract to exchange a fixed amount of a financial or non-financial asset on a fixed future date at a fixed price. The fair value of a forward contract is affected by changes in the spot rate and changes in the forward points. And the currency basis spreads means that it's the liquidity charge for exchanging different currencies that is inherent in a foreign exchange contract. Many entities included this spread when applying the hypothetical derivative method for assessing hedge effectiveness for cash flow hedges. Now, based on PSAK 71, it will be treated in the same manner as time value of options, which has been explained before. Now, next will be explained by my friend, Vincent.
Okay, thank you, Maura. Now I'm going to tell you about hedging for items group. First, hedging of net position. The net position qualifies for hedge accounting only if the entity hedges on a net basis for risk management purposes. Therefore, the entity cannot apply hedge accounting on a net basis solely to achieve certain accounting outputs if it does not reflect a risk management approach. If the entity manages the risk of foreign exchange on a net basis and does not enter into a foreign exchange derivative contract, the entity will be in a natural hedge position for 9 months. Next, what about a cash flow hedge? If a hedge is a hedge of fair value, then the net positions may qualify as a hedging item. However, if a hedge is a cash flow hedge, then the net position can only qualify as a hedging item if the hedge is a hedging foreign exchange risk, and the determination of the net positions determines the reporting period in which the estimated transaction is expected to affect profit and loss, and also determine their nature and volume. Next, items group defined as hedge items. Now I'm going to tell you about this, about item group layers. Hedging relationships can include layers from several different groups of items. For example, in a hedge of the net positions of a group of assets and a group of liabilities. These two, assets and liabilities. These two groups can consist of, in combination, the component layer of the asset group and the component layer of the liability group. Next. Presentation. Now I'm going to tell you about the presentation of gain or loss of hedging instrument. First, if items are hedged together as a group in cash flow hedge, they may affect different posts in the statement of income and other comprehensive income. The presentation of hedging gains or losses in the statement depends on the group of items. Second, if the item group does not have an offset risk position, for example, a group of a foreign exchange cost that affect different items in the statement of profit and loss and other comprehensive income hedged for foreign exchange risk, then the reclassifications of the hedging instrument will be fairly divided to a post that is affected by hedging items. And last, if a group of items that have a risk position is mutually exclusive, for example, A group of sales and expenses denominated in foreign currency are hedged together for foreign exchange risk. Then the entity presents hedging gain or losses in a separate item in the statement of income and other comprehensive income.
Okay, now I'm going to tell you a correlation with accounting theory that we have learned before in the class. As Indonesian market is inefficient, then we believe that regulation is still needed and important. Thus, IFRS 9 or PSAK 71 is one of the ways for the government and standard setters to regulate the making of financial statements. It is coherent with the public interest theory. On the second, PSAK 71 is a mix of positive accounting theory and normative accounting theory. PSAK 71 observes what is currently happening and prescribes on a better regulation. And PSAK 71 is based on observations of public commentary and problems regarding subprime mortgage. PSAK 71 then recommends what ought to be done.
Okay, so that's all for today about hedge accounting based on PSAK 71. Don't forget to hit the like button, subscribe, and should you have any question, leave on the comment section below. See ya!